Well, hey there. I wanted to do a quick, very short overview of the bank on yourself strategy as it relates to real estate investing. I thought this might be relevant in your field of expertise and work. So I wanted to jump into an idea or a question, really. The first question is, backing out of all financial vehicles, get rid of the labels, everything. What is it that helps you accomplish what you're trying to do with your financial life? I don't care if it's a real estate or savings accounts or annuities or 401ks or hedge funds. Anywhere you put your money will make it act different. In other words, where you put your money makes it do different things. That's such a simple, obvious statement, but I think it bears a thought process, at least as we get into what is it we're trying to get our money to do for us, for you. So if you could design the perfect financial instrument for real estate investing and ultimately for retirement and your full financial life, what characteristics or attributes would be important to you? That's a good question. You might take 5 minutes and think about that. For me, when I was looking at that, I put together a short list, a few items, characteristics, ideas, strategies, attributes of what I want my money to do for me. For me, the short list included things like easy access to cash. And that means like liquidity. I want to be able to use that money for anything I need. I didn't want restrictions on my money. Safety. I wanted it to be protected and safe so that I could use it for other investing like real estate and so forth. I wanted some sort of safe money to go with my investing. I wanted guarantees on my principal, meaning I wanted some sort of assurance that my money was going to be there when I went to look for it. And I wanted it to also have some sort of predictable growth pattern that I could count on, again, to kind of lay against other things I might want to do with real estate investing. I also was interested in tax deferred accumulation. I didn't want to be taxed every year. Some savings accounts, money market accounts, brokerage, they're going to be taxing you every time you have realized interest or gains on the savings account, for example. I also wanted tax-free access to my cash. That was important to me as I was looking at my own wish list. And I wanted this to be somehow the perfect financial instrument. So again, I didn't want things like contribution limits, the government telling me how little or how much I could put into this financial vehicle. I wanted some flexibility. If I had a tough year or a tough month, I didn't want to be forced to put money into something. Vis-a-vis like maybe a real estate mortgage payment, for example. And then thinking about tax-free gifts to my family as well. I didn't want the government to be the major beneficiary on all my hard work throughout my lifetime. And I wanted it to be privately owned, something that would be outside of the reach of creditors and lawsuits and so forth. So that was my short list. Now, does something like that actually exist? And is it legal? Is many times the next question a lot of people ask. And the answer is yes. In my view, no financial vehicle works better for real estate than a massively maximized and modernized dividend-paying whole life insurance policy. We refer to it as bank on yourself type policies. So what is a bank on yourself type policy? Well, it's using the chassis or a contract, insurance contract that has grown guaranteed and given more cash increases to their policyholders every single year for over 160 years, including the Great Depression, including the Great Recession, and every boom market cycle, every bust market cycle. They are going to give you nice, predictable, moderate returns, something much better than cash equivalents would pay. Better than, I've sometimes said it's sort of like a triple B bond fund in terms of yield, but a triple A bond fund in terms of safety and security. So you get easy access to your cash. Unlike a bond fund, you can liquidate or use the cash in this policy for any reason. You could use it for including real estate investing. You could also use it for your own kitchen upgrades or sending your kids to college. There's really no limit to what you might use the money for. Of course, it is life insurance, so you'll leave your family more than you could ever save. And crucially, for real estate, you're able to become your own source of financing. And I'll get into that a little bit more here in a minute, but the policy itself is different than old-fashioned life insurance. This is not a heavy commission or heavy expense death benefit. It's built with massive cash value from the start, from the first month. You have significant cash value. This is a mutual life insurance company that typically issues these. We work with a number of companies, but the companies I prefer are mutual companies where you in essence, are the owner of the company, and you can control those profits and receive dividend checks as a return of premium as well. Gains are locked in, and the gains are predictable. In fact, when I get a dividend check from Coca-Cola or Tesla or something, and then I reinvest it back into that stock, I could lose that dividend next year, couldn't I? But with the dividend checks of a life insurance contract, if I put those into paid up additions, that's locked in, guaranteed cash value growing forever for the rest of my life. So I can know on a predictable schedule exactly what my net worth is going to be this year, next year, 5 years, 10 years, doesn't matter. It continues to grow uninterrupted. And then the final thing here is when you borrow from the policy, when you build up enough cash value in the policy and then borrow against it to pay cash for things like your property taxes or your down payment on a real estate deal or a full cash purchase, your policy itself will continue to grow as if you had not touched a dime of the money. That is huge. Think about that for a minute. Your money is doing two things at once there. You've got your money working in the policy, and you've got it working out here in the real world with the investment, whatever it is you've decided to invest in. So that is a powerful tool in my book for using the policy as a source of funds for your real estate deal. Okay, so let me skip ahead here to something I can sort of think through. Okay, so here's 4 quick steps on how you can use real estate, use Bank on Yourself for real estate investing. You can use that equity, your cash value in your policy to purchase some real estate. Okay, so you build up cash in the policy, you buy some real estate. Step 2, you borrow against the policy, and the policy keeps growing even on the capital you borrow. Step 3, you control the repayment schedule to the policy that you own. So if you want to use your rent check from your renter to pay back the policy loan, that's great. If you want to wait until you sell that flip, fix it up and then flip, not pay a penny on the loan until you've sold the property, that's great too. Or wait until that private placement or syndication gets sold, and then you just pay the loan off in full after 3 years. Totally up to you. You put the money back in the policy and you recycle the money and then send it back right out to the next investment, whatever it might be. And the policy continued to grow even while we were waiting for that loan to be repaid. Pretty remarkable. So in these final minutes, I thought I'd quickly share one strategy that's been really valuable for a lot of our clients, and that is the full cash purchase, where you're able essentially to borrow from the policy and pay cash for the property at closing. So you are a cash buyer in the eyes of this transaction, but you're using the policy as your source of money. So what does that help you do? Well, it increases your yield without any additional real estate risk. And you're developing for yourself inside the policy a permanent line of credit that's ready for the next recession. So, I say, there's that old quote by Mark Twain, a banker is a fellow who lends you his umbrella when the sun shines, but wants it back as soon as it starts to rain. So I thought I'd show this to you in action here. So this is a picture of somebody who's putting in $32,000 a year for 10 years into a policy. Now, your numbers are going to be different than anybody else's, and everybody will have more or less. You could take a zero away or add a zero to these numbers here. But he only funds the policy for 10 years, and then he just lets the policy fund itself after the 10th year. Now, keep an eye on these dividends, and I want to also point out the cash value in year 15. That's going to be important to us as well. So that's $515,000. Keep that number in mind. That's the cash value in year 15. Now, same guy, same policy, but now he's taking a loan for $350,000 in the 11th year. Maybe he's buying a cash purchase. And that policy dividend is still exactly the same as it was whether he took that loan out or not. Pretty cool. In this case, he never paid the loan off on this screen. But now let's move forward to the next screen where he does pay the loan off. If you pay the loan back and watch that loan be paid down. So he's paying that loan off over 4 or 5 years here, it looks like. He'll have exactly the same cash value and death benefit as if he had never taken the loan out in the first place. So he has the real estate and he has the policy. Let's kind of lay this all out side by side. So in this example, I took a guy who bought a $350,000 house. And let's say that it appreciated over 5 years at 3% a year, something real standard and simple. Well, if he just paid cash, walked into the bank, withdrew some money and paid cash for that house, that cash in the appreciation of the real estate would grow from 350,000 to 405,000 over 5 years at 3% a year. That's a compound growth of 55 grand. Plain and simple. All the money is trapped in the drywall of that house. And there's no loan interest since we're not borrowing from the savings account. There's no policy involved when you pay cash for a house, so there's no policy growth. So we have a pure and simple 55 grand or 3% rate of return. Now, when we use the bank on yourself strategy, the house in the neighborhood is going to continue to appreciate, no matter what, right? The house is going to be worth whatever Zillow and the neighborhood says it's worth. Now, if we use the policy to buy that house, there will be a loan on the policy, and there's a loan interest rate that's charged on the policy. You can go see those numbers on the previous slide. The loan interest is 2.1%. If you do the math on that, about $38,000 of interest paid over 5 years. Not too shabby. Who wants to pay 38 grand? I don't know. Nobody that I know, but at the same time, your policy grew by $119,000, $119,000 without you putting any extra money into the policy. It just did this on its own from year 11 to year 15. So that's a rate of return when you factor in the policy and the real estate of 10% and an overall growth of $175,000. Now, which of those two numbers would you rather have if the transaction was the same, right? It's just a matter of where we're pulling our money. Again, where you keep your money makes it do different things. So, I'd love to speak with you more about this if this is something that's of interest to you. Just go to this website, lakegrowth.com/schedule, and click on phone introduction. That'll help me and our team get to know you and schedule a time right on our calendars for us to speak with you about this strategy or a number of other strategies that use this concept for real estate investing. Thank you so much. Hope you're doing well. We'll talk to you soon.